For decades, the financial world has sought wisdom from the Oracle of Omaha, Mr. Warren Buffett. His company, Berkshire Hathaway, stands as a testament to his investing prowess, built on a foundation of patience, discipline, and a deep understanding of value. Buffett's success isn't about complex algorithms or risky bets, it's about sticking to fundamental principles. In this video, we're going to unlock 7 of Warren's most essential rules for building lasting wealth. Whether you're just beginning your investing journey or looking to refine your approach, these timeless principles will serve you well. Building wealth is a marathon, not a sprint. It's about making smart, informed decisions consistently over time. So let's dive in and unlock the secrets to lasting wealth, guided by the wisdom of one of the greatest investors of all time. Rule number 1 is simple. Never invest in a business you cannot understand. Stay within your circle of competence. Focus on what you know, and you'll be well on your way to making smart, profitable investments. The best investment you can make is in yourself. The more you learn, the better equipped you'll be to navigate the complexities of the market. Once you understand a business, determine if it's a high-quality business. I'm talking about companies with a durable competitive advantage, something that sets them apart from the competition and allows them to generate profits for years to come. Think about a company like Coca-Cola. They've built an iconic brand, a global distribution network, and a product people keep coming back for. When you invest in quality businesses, you're not just buying stock, you're partnering with excellence. Look for companies with a strong track record of profitability, a healthy balance sheet, and a management team that's aligned with shareholders' interests. These companies might not be the flashiest or trendiest investments, but they're the ones that will stand the test of time. Remember, investing is not about chasing the next hot stock tip. It's about identifying companies with enduring value and holding them for the long haul. Be patient, let compounding work its magic, and watch your wealth grow steadily over time. By focusing on quality, you're not just investing in companies, you're investing in your own financial future. Quality businesses are the bedrock of a sound investment portfolio. In the world of investing, patience is not just a virtue, it's a necessity. The stock market is a fickle beast, prone to short-term fluctuations driven by fear and greed. But over the long term, it reflects the growth of the underlying businesses. That's why it's crucial to adopt a long-term perspective. Don't get caught up in the daily noise of the market. Focus on the fundamentals of the businesses you own. Remember the power of compounding. Even small gains, when reinvested consistently over time, can lead to extraordinary results. Avoid the temptation to jump in and out of investments frequently. Every trade comes with costs, both in terms of fees and potential tax implications. Identify high-quality businesses with a long runway for growth and let your investments compound over time. Time is the friend of the wonderful company and the enemy of the mediocre. Think of yourself as a business owner, not a stock trader. Just as you wouldn't sell a profitable business after a few good months, don't be quick to sell your investments when they experience short-term volatility. The stock market is not a casino. It's a mechanism for owning a piece of great businesses. Approach investing with a long-term mindset, and you'll be well positioned to weather any storm. Stay focused on your goals, tune out the noise, and let the power of compounding work its magic. This next rule is perhaps the most contrarian, but it's essential for long-term success. Be fearful when others are greedy and greedy when others are fearful. In other words, go against the herd mentality. When markets are soaring and everyone is euphoric, it's tempting to jump on the bandwagon, but often that's precisely the time to be cautious. Remember the dot-com bubble? Investors piled into tech stocks, driving prices to unsustainable levels. Then the bubble burst and countless investors lost fortunes. Conversely, when fear grips the market and prices plummet, it's easy to succumb to panic. But that's often the best time to find bargains. Think back to the 2008 financial crisis. While many were selling in a panic, I saw an opportunity to invest in quality businesses at deeply discounted prices. It's not easy to go against the grain. It takes discipline, conviction, and a willingness to stand apart from the crowd. The market is driven by emotions, fear and greed. By recognizing these emotions in ourselves and others, we can make more rational decisions. When you see everyone rushing towards one investment, take a step back and ask yourself, what do I know that they don't? Don't let fear or greed dictate your investment decisions. Let logic and reason be your guide. The market rewards those who can keep a cool head in the heat of the moment. Avoid debt. Debt can be a dangerous tool. It can amplify your gains, but it can also magnify your losses. That's why I've always been wary of using leverage, both personally and in business. Debt can be particularly treacherous during times of uncertainty. When things are going well, debt payments might seem manageable. But when the unexpected happens, a job loss, a health crisis, or an economic downturn, debt can quickly become an unbearable burden. Instead of relying on borrowed money, focus on living within your means and building a solid financial foundation. Start by creating a budget and tracking your expenses. Identify areas where you can cut back and redirect that money towards savings and investments. The less debt you have, the more financial freedom you'll enjoy. You'll be better positioned to weather financial storms and take advantage of opportunities when they arise. Financial peace of mind comes not from having more, but from owing less. Pay attention to valuation. No matter how much you love a business, it's crucial to pay attention to its valuation. Even the best company in the world is a bad investment if you overpay for it. Valuation is all about determining the intrinsic value of a business, what it's truly worth based on its future earnings potential. There are many ways to value a business, but some common metrics include price-to-earnings ratio, price-to-book ratio, and dividend yield. Don't just rely on one metric. Consider multiple factors and look for a margin of safety. Try to buy a business for significantly less than you think it's worth. This provides a cushion against potential mistakes or unforeseen circumstances. The market can be irrational in the short term. Prices can fluctuate wildly based on sentiment and speculation. But over the long term, value will out. Think of yourself as a value hunter, always searching for bargains in the market. Be patient, be disciplined, and wait for the right pitch. The price you pay for an asset is the single biggest determinant of your investment returns. Keep emotions in check. Investing is as much about managing your emotions as it is about analyzing numbers. Fear and greed are powerful forces that can lead investors astray. When you let your emotions dictate your investment decisions, you're more likely to make costly mistakes. You might buy high out of fear of missing out or sell low out of panic. The market is a roller coaster. There will be ups and downs, twists and turns. The key is to stay calm and focused on your long-term goals. One way to keep your emotions in check is to have a well-defined investment plan. This plan should outline your investment goals, risk tolerance, and asset allocation strategy. Having a plan in place will help you stay disciplined when markets are volatile. It will remind you of your long-term objectives and prevent you from making impulsive decisions. Investing is a marathon, not a sprint. There will be times when you'll be tempted to deviate from your plan. But it's crucial to stay the course and trust in the process. The most successful investors are not the ones who get lucky. They're the ones who can control their emotions and stick to their plan. So there you have it, 7 timeless rules from Warren Buffett for building lasting wealth. These principles are about more than just making money. They're about cultivating a mindset of patience, discipline, and long-term thinking. If you found this video helpful, please consider subscribing to the channel and hitting the notification bell so you don't miss out on future insights. And if you know someone who could benefit from these timeless principles, please share this video with them. The journey to financial freedom starts with a single step. Start applying these rules today, and you'll be well on your way to building a brighter financial future.